it's Bob Hoopster, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. NEOS is an ETF sponsor, and its ETFs aim to deliver the next evolution of option strategies that seek income as the outcome. Built on decades of research and experience, NEOS ETFs aim to empower investors with portfolio building blocks to provide high monthly income, tax efficiency, and diversification through data-driven, options-based ETFs. Today, I'll speak with Garrett Paolella of NEOS Investments to learn more about its suite of ETFs, its potential benefits, and where they may fit in investment portfolios. Garrett is an experienced financial services executive with a track record of launching and managing asset management companies. He is a co-founder and managing partner at NEOS Investments, as well as portfolio manager to all NEOS ETFs. Let's start off by having you give us some background about yourself, your career path, and what led to the launch of NEOS.
Sure. Thanks, Bob. Appreciate being here today, and thank you for the opportunity. My background has really been focusing on option-based investing since about 2008. I originally worked with a lot of large hedge funds and mutual fund companies, helping them craft ways to use options to either enhance their returns, diversify overall risk, or really focus on tax-efficient income. And the tax-efficient income piece is what really got me excited, thinking about investors in the marketplace, how they're trying to achieve retirement and get to a portfolio that they feel comfortable from a net after-tax point. I launched my first asset management company in about 2012, which was really one of the first pioneers in the option-based ETF category. We had a suite of covered call-based ETFs that were focusing on high degree of current income for clients, and really has continued to build upon my passion that we can be a solutions-oriented ETF issuer that thinks about your entire portfolio and the asset allocation holistically. And launching of NEOS Investments has allowed us to further, between myself, my partners, and our team, to really further the amount of product and the solutions that we can bring via ETFs through option-based strategies, not only now just in equities, but in fixed income and cash, other types of alternatives, even emerging asset classes. And so it really allows investors to espouse their market views and what it is that them or their clients are looking to achieve, through either an equity allocation, a fixed income, a cash, a mix of, all three, and the broader asset allocation. And so NEOS is really around to continue to be a solutions provider within the option-based ETF category.
You have three ETFs, SPYI, CSHI, and BNDI. Tell me about them and why you launched them and why you felt there was a need for them in the market.
Sure. I'll take one at a time. So for SPYI, that is the NEOS S&P 500 HighIncome ETF. It targets a equity portion of your allocation. We are fully replicating the S&P 500 equities to gain equity exposure. And then on a monthly basis, we deploy a rules-based and data-driven covered call strategy. Ours focuses on options being out of the money to marry up the income with growth and upside within your equity part of your portfolio. But the key is really to deliver a tax efficient 10 to 12% a year in your portfolio. So clients that are willing to take equity like volatility, although being slightly less than if you were just in the S&P 500, it fits within that equity type allocation for a tax efficient 10 to 12% yield. BNDI is our NEOS Enhanced Income Aggregate Bond ETF. And we are basically getting exposure to core or aggregate based bonds and adding an additional 2 to 2.5% of tax efficient income above what you're getting out of the core bonds. So we really want to allow clients to know that that can be a replacement or a complement to your core bond allocation, but generating you an extra 2 to 2.5% above what core bonds deliver. CSHI is the NEOS enhanced income cash alternative ETF. Very unique product in that we are long 90-day US Treasury bills, currently generating north of 5%, given where the inverted yield curve is. And then we deploy a rules-based option overlay strategy that seeks to generate 1 to 1.5% above the treasuries. So you're basically getting three products that either fit one SPYI in your equity bucket with a 10 to 12% yield, BNDI within your core bond yield part of your portfolio for 5 to 6%. And then right now, a cash alternative that would replace or complement cash, money market, ultra short duration bonds. And given the inverted yield curve, you're getting north of 6%, in that product today.
It sounds like the common element across those three ETFs is that they provide a core portfolio exposure and then sell S&P 500 index options to generate income. And I know you're also using Section 1256 contracts to minimize the tax consequences. Can you elaborate on that a little bit?
We use S&P 500 index options on all of the products for a couple reasons. One, there's certainly liquidity there being within the S&P 500 index. Two, the actual S&P 500 index options provide you that 1256 tax treatment, which simply just means that any gains and returns earned from those investments are taxed at 60% long-term capital gains rates and 40% short-term. So it's really deriving a tax-efficient return or tax-efficient income, as opposed to sometimes single equity stocks like linked to Apple. They're all 100% short-term, which means that's an ordinary income for individuals, or things like structured notes, equity-linked notes get that same designation of a all short-term, which means that investors in the mid to higher tax brackets, right, can be giving up almost half of their ultimate income because it falls in the ordinary income. So we really use S&P 500 index options to ensure that the net after tax income that's being distributed or the return that we're generating is going to be as tax favorable for our investors as possible. And then, as I mentioned earlier, it's also trying to drive having plenty of liquidity being within the S&P 500 index.
Since your strategies depend on options, selling options, how will performance relate to market volatility? Because as the volatility of the market increases, then so does the price of options. More volatility, you're generating more income. Does that mean your performance will improve when you are selling options when there's higher volatility?
So it's an interesting question. There are two sides to that. Yes, when volatility is higher, that means the price of options are more expensive. So when selling them, we get to generate a higher degree of income or potential return. However, it also depends on the direction of the market. So volatility could be high and it goes nowhere. That's great for us. Volatility could be high and then the market ultimately goes higher. That's generally good for us as well. So there's a relationship between volatility and also the direction of the market, and that's why it's important usually to use a professional, option-based manager. To that, you're getting the ability to leverage volatility as an income and as an asset class, but we're able to marry up that. Not always that low volatility is a bad thing, right? It's the direction of the market heads the way we want it to. That still provides positive returns, or we get the opportunity to leverage high volatility to generate more income if the market stays flat to slightly higher or even slightly lower. That can be a good thing as well. So option volatility is a good thing, and there's opportunity for that to not only produce returns just from having volatility in the market not heading in a certain direction, or having volatility in the market heading in a certain direction.
Talk about the key differentiators between the NEOS ETFs versus some of the other similar offerings that are in the market.
Sure. So I'll break those down into each one. So for SPYI, our high income covered call based product, one characteristic that's different is we use the index options. So we're very conscious again on that net after tax income. A lot of other products in the marketplace use the single equity options I was referring to, or even equity like notes or structured products. And we really want that tax efficiency. So that's a key difference. Another one is on the SPYI product is we sell out of the money options and we ladder those. So meaning we want to be anywhere from 1.5 to 4+% away from where the current market is. And so that being out of the money options allows for a lot more upside appreciation in the portfolio. And then third, we don't need to write on the entire portfolio. So if we hit our income target, then we don't look to write on the entire portfolio, which again allows for more equity appreciation. So those are kind of three unique characteristics that differ from other products in the marketplace for SPYI. For BNDI, there's really not another product that compares directly to this. Again, we're choosing a core aggregate bond exposure and looking to match the same volatility risk profile of the core bonds to what the option strategy is. So that way it fits still in that core bond allocation. So we really think about that as more of a newer, unique product. Similar for CSHI, there is not another cash alternative product out in the marketplace that delivers what we do. We looked at kind of ultra short duration bonds as more as the comparison, meaning that if you're in an ultra short duration bond product, you're getting all ordinary income from that short duration fixed income positions. We wanted to use treasuries as our short duration because of the tax efficiencies that come with treasuries. And for any of the listeners that don't know or don't traditionally invest in treasuries, treasuries are exempt from all state and local taxes for investors. So you only pay your federal rate. And so we view the ultra short duration bond and the treasuries as a comparison, but much more tax efficient on the treasuries. Plus, whether we all want to joke about it at some point in time, they are 100% guaranteed by the US government, as opposed to corporate ultra short duration fixed income. And then we add that options piece, which nobody else is doing as well, because you could go out and just buy a treasury fund. But we want to add that extra 1 to 1.5%. And so the options are what makes, the product more unique relative to others in the marketplace.
What are the expense ratios for the ETFs?
Great question. SPYI, the equity product, is 68 basis points. BNDI, the core fixed income, is 58 basis points. And CSHI, our cash alternative, is 38 basis points. And we price those based on what we think the expected risk and return profile to be for investors. That as you take more conservative risk and might have a lower potential return, being in cash versus equities, that should be taken into account when pricing, ETFs.
CSHI is up 3.28% this year versus 2.57% for its Morningstar peer group, which is ultra short bonds. SPYI is up 14.43% versus 13.43% for its Morningstar peer group, which is US large blend. By the way, we're recording this on July 6th, and I got those numbers last night. So they've had some early success. What were the drivers behind that?
Sure. So CSHI has been able to deliver the additional return from the option-based strategy. That's seeking 1 to 1.5% on an annualized basis above the treasuries. And, given the market and where volatility has been, it has really allowed us to capture, almost the entire amount of what the option-based portfolio is set out, to seek. For SPYI, why we're able to outperform kind of that US large blend category is that we've weathered certain months of drawdowns because of the short options and the income we've been able to generate. So we've been able to outperform on the downside relative to just the equity exposure. But then, as I talked about, the investment process and strategy is really about having the options portfolio being out of the money, away from where the current market is, so that in a normal kind of positive month, we're able to capture the majority of that upside. Plus, we didn't write on the entire portfolio. So that has allowed us to have an equity piece that has full upside capture to what regular equities have done. So the mix between the outperformance on the downside and the upside capture in good months has allowed us to really actually outperform just being within that US large blend category that you mentioned.
So you place a lot of emphasis on tax efficiency. throughout on your website as it pertains to the ETFs. Tell me a little bit more about that, and also what is the turnover in the ETFs?
So the tax efficiency for us, as I've been mentioning throughout this, is in my background. That's a real key characteristic for us in the way we think about investment management. Um, it's one thing to generate gross returns for investors, but if those investors then pay out the majority of that uh, to the IRS and taxes, that's what risk are they really taking for the net return they're getting? And so not only have I been talking about how we use SPX index options to generate the tax efficiency across all products, but each one has their own characteristics. So on SPYI, we're using the tax efficient index options. We also then will look to generate any tax loss harvesting. So from an option side of the portfolio, or even from an equity piece, can we marry up a loss somewhere in the portfolio that we can realize with what that distribution is to investors? And if so, and we've been able to deliver that looking at the history of the product, we actually get our distribution categorized as a return of capital, something investors might know through MLPs, to where you're able to take a distribution of gains and returns. And we're talking about return of capital in our standpoint of, we call it constructive return of capital, meaning that we've generated returns and positive returns above the investor's initial investment. So we're not returning them their principal. We want to be generating returns from either the equity portfolio or the option portfolio to meet that distribution. And so this return of capital means investors in that given tax year do not pay taxes on that distribution. Let's call it that 10 to 12%. What it would do over a longer period of time is reduce their cost basis in the fund, basically converting their returns into all long-term capital gains. So if they sold the fund somewhere in the future, they're in the most favorable tax bracket that they can be from an investment. If they don't sell the fund, estate tax planning, as I think your audience knows even better than I do, the beneficiaries of an individual passing on their estate allow for all of the ETFs to reset their cost basis for that individual at current market rates. So very tax favorable from the equity standpoint. On BNDI, we use those tax efficient index options. And I would say that's the key characteristic within that product, because we're owning core and aggregate bond exposure. And unfortunately, there's no secret sauce to be able to convert that interest income coming off of those bonds into something more tax favorable. So the option side is what gives the tax efficiency. And CSHI, it's the option strategy again that we've been speaking about, but then also the treasuries, as opposed to using ultra short duration bonds. So those are kind of how the three products are tax efficient. Each ETF has its own unique characteristics on why they're tax efficient given the underlying investments.
How have advisors been using ETFs in their client allocations? Where do the allocations come from when they add one of these ETFs?
We've seen, a mixed adoption across both advisors and retail. Direct, retail to people finding us, via the website, or their professional traders with their own individual Schwab or TD Ameritrade or Pershing accounts. Unsure on where they utilize it besides as a high degree of tax efficient income, off of your core exposure. But from the advisor standpoint, we are seeing it exactly how we had set out to launch this first suite of products. The SPYI in a equity-based allocation. That's either replacing just core equity exposure, long-only equity exposure. It's replacing equity dividend-based strategies, potentially REITs, and some preferreds and some MLPs, to where you're thinking about an equity-like volatility in your portfolio. They're utilizing that as a complement or replacement. BNDI is used as basically a replacement to core bond exposure. We've seen them trim their AGG or BND, kind of just general core beta exposure to it, to getting something that's got the same general volatility, but a much more tax efficient income, above that. And for CSHI, interesting. That has taken adoption in a couple ways. One, as just kind of that general 3 to 5% cash allocation that advisors have historically had in their portfolios. Another way is replacing part of their ultra short duration bonds. So thinking about that general lower risk based bucket. But actually, now we've heard from a lot of advisors, they're actually using cash as an asset class, given where the yield curve is currently, and the steepness of that curve. The fact that treasuries right now on 3 to 6 months are generating you between 5.25% and 5.5% on a tax efficient basis with no risk. That's really attractive for a lot of investors in general. So we're seeing CSHI also being just used as its own allocation and bucket, just given where interest rates are, and cash now being kind of back as an asset class and an investment sleeve in people's portfolios.
So, why are NEOS ETFs a compelling option in the market now as well as over the longer term?
The tax efficiency and the total return characteristics of the products that we've built are really attractive tools in the overall building of an asset allocation for clients. Whether you're looking at equities, core bonds, or cash, we give the building blocks, to be able to meet the client's risk profile, but also generate an above average tax efficient income by supporting a healthy total return to the funds.
If there's one key takeaway that you'd like to leave with our audience of advisors about the diligence that they should perform on an options based product such as yours, what would that be?
Yeah, I would say not all option strategies are created equal. It's a big phrase that I've been out with. The growth in the option based ETF market, from us being the only issuer with 95% market share in our previous business to where it is today, it has been probably one of the most explosive growth categories. And so you're getting, pun intended, the optionality now out there through these option based products to build portfolios to how you might have done that with your equity based allocation or your fixed income, right? You're choosing large cap, mid cap, small cap, where you're choosing factors of beta and volatility or growth and value. And what we're seeing in fixed income, right? You're trying to, manage to credit quality, to duration, to yield. We think about that in the option based portfolio as well. It's not always comparing one option product to the next. It's how can you build a good comparative and complementary portfolio using option-based ETFs. And so I would make sure that you do have conversations with whoever the portfolio managers or the firm issuing the ETFs are, so that you can understand exactly what the benefits are and where they should fit in your portfolio. We're happy to talk about exactly where that fits with our products. You should be able to do that with other managers. So you either are playing for a downside protection, a tax efficient income, an upside growth, or building a holistic portfolio with option-based ETFs to meet your clients', objectives. But I would say always have a conversation with the issuer, make sure you understand the actual product, what they're looking to achieve, within it, because they are all different. Even if the names can be somewhat similar, everyone always has a different, spin on their portfolio management.
We will include some links in the notes that accompany this podcast where you can get more information about NEOS. There'll be a link to the NEOS website, a link to schedule a meeting with Garrett and his team, and then links to 3 fact sheets on the NEOS ETFs, SPYI, CSHI, and BNDI. Garrett, is there anything else you'd like to add?
I'd just like to thank you, Bob, for your time today, and Advisor Perspectives and Vetify for hosting me on this podcast and giving us the opportunity to tell our story. So thank you very much.
You're welcome. And thank you for listening to the Gaining Perspective podcast with Bob Hoopsher, today featuring Garrett Paolella of NEOS. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on iTunes, Spotify, and Stitcher.